Every month, the people who own a piece of an oil well get a deposit in their bank account. Most Americans have no idea this is even possible, and especially how you can use this to reduce your legal tax rate down to zero. So let's walk through it, through the actual math, and the whole goal is by the end of this video, you're going to be able to calculate to the dollar what an oil well investment pays you each and every single month, how your legal ownership is registered, and how our investors use our oil and gas projects to pay 0% taxes legally. And we'll use a real project that we're working on right now, so the numbers are real, not hypothetical. And by the way, obviously, this is for educational purposes, not investment advice or soliciting for investment. You can reach out to us separately for that. I just want to use real numbers so you get real education on how all of this works end to end. Deal? Okay. We're going to dive in and stay with me. The first 30 seconds of math is going to make every dollar invested in oil and gas feel different. And before we can get to the money flow, you need to understand how oil and gas ownership works in this country. When you invest in an oil well, you don't own the oil underneath or behind the pipe. You own a percentage of the well production and a percentage of every barrel that comes out of that well as long as it produces. Now, your percentage of the well is called a working interest, or WI for short when you see it on statements. If you buy 1% working interest, you own 1% of everything that well produces. Every barrel, every month, for as long as the well is in production, but here's the caveat. You don't get to keep 100% of all the revenue tied to your 1%. The mineral owner, landowner, and other involved parties will likely get a cut before the working interest owners get their production monies. So the second piece of information here you need is what's called a net revenue interest, or NRI. Most commonly, the NRI is 75%, meaning every barrel sold, 25% of it goes to the mineral owners, landowners, or the other parties that allow us to drill and operate that lease. The other 75% is then split across the working interest owners, pro rata to their percentage. So now you know the two numbers that help determine your check size. Your working interest tells you what slice of oil production you own, and your net revenue interest tells you what slice of revenue flow to the working interest owners. Let's use these now to calculate your monthly check size from production numbers, and you'll be able to understand any of the statements that come to you when you get your oil check every single month. The number you need to have, and that you'll see on every statement, is what's called BOPD, barrels of oil per day. Every producing well puts out a certain number of barrels per day. Some wells do 100 BOPD, some wells do 1 BOPD. The wells in the real project that I'm going to walk you through, some are over 100 years old, and they're still doing 3.5 to 4.5 BOPD each. Once you have the BOPD, the calculation for what hits your bank account each month is pretty straightforward. Here's a formula. And remember this one because it works for every oil and gas investment all the time. BOPD multiplied by your net oil price, by your NRI, 30 days per month, and your working interest. That's your monthly check size. I say net oil price because of taxes, but we'll get into that later. But that's it. We have 5 numbers, no black box, no fund manager, no pay statement that you can't understand or decode. You can calculate that on the back of a napkin. Let me show you what this looks like in the real project that we're running right now. And again, this is just for educational purposes. I just want to show you what a real project will actually look like. It's a 62 well restoration project in the Texas Panhandle. The basin is called the Anadarko Basin, and we have 8 wells in production already. The other 54 we're bringing back online over the next 12 months. This is not drilling, and let me explain why that's important. An existing well gets stopped for various reasons. An oil price crash may put it economically offline, or a lack of parts or servicing during an oil boom can also stop production. The key difference between drilling and restoration is risk. You get the tax deductions, which we'll cover in a little bit, all the same. With this restoration project, the oil is already there. So income calculation from day one is from real production. Just use the formula from before. Then as a project uses the capital raise to increase the number of active wells, your check size each month will also grow as more BOPD is added to the production property, which we call lease. Next, let's calculate the real numbers using this real project so you can fully understand, end to end, how our production becomes money in your bank account. So day one here in this project, we have 8 wells in production, each averaging 4 BOPD, using a conservative oil price of 85 a barrel. Even though, yes, I know there's a war going on in the Middle East and oil is bouncing between 90 and 100 and may go higher. A smart investor here always forecasts using a lower oil price because oil is cyclical and probably always will be. Plus, there are some production taxes and expenses, usually $5 to $10 per barrel, that you want to factor in. Now, if you bring in the minimum amount for this project, 100K, and acquire 1% working interest, this is what your monthly check from day one will look like. you have 4 BOPD times 8 wells, $85 oil, 75% net revenue interest, 30 days on average per month, and 1% working interest. Your check size works out roughly to this number, about $600. That is about $7,300 gross in the first year. And that's before we've worked over any single well. Now, important observations here is first, you're getting about 5 to 7% per annum cash yield. To me, you're already doing better than the T-bills and the savings account that you can put your money in. Second, we haven't gotten to the tax piece yet, but that tax piece is what makes oil and gas investing different from anything else you can put your money into, including oil stocks. More on that in a sec. We need to finish covering what happens when the 54 wells come online. The same formula applies, so you can calculate your monthly check size after the restorations are done. And ultimately, that's the reason to invest in a project like this in the first place, rather than just sitting in T-bills. Let's walk over that calculation real quick. With 62 wells in production and using 2.45 BOPD each for when the wells come online, which by the way is already below our current production rate, but hey, let's be conservative here. Total field production is going to be 150 BOPD. Let's use that same formula to do the math. Same 100K, same 1% working interest, same $85 oil. 150 BOPD, $85 oil, 75% net revenue interest, 30 days and 1% working interest. We have $2,869 per month. That's about $34,000 gross per year for each 1% of the working interest. Roughly, that's 34% annual yield, paid monthly to you. It is also backed by a physical asset that doesn't really care what the stock market does. It only cares about the oil price. And remember, this is our base case. It doesn't account for oil price going to 100 or 120 or above. It also doesn't account for the wells producing above 2.45 BOPD. Now let's walk over the best cherry on top. Because the cash flow is the foundation of your returns, the tax treatment is what separates oil and gas projects like the ones that we have from every other investment category. And this is how the wealthy have quietly used this asset class for the last hundreds of years to get their legal tax rate down to zero if desired. If you're thrilled about the tax breaks that you get in real estate, just wait till you see how oil works. That's next. Here, what most people don't know about oil and gas investing, including the CPAs who are not in the oil and gas space. The IRS allows you to deduct 100% of your investment in the same calendar year you make it. Right, listen to that again, because real estate doesn't do this. If you invest 100K into a working interest, like our restoration project or drilling projects, you get to deduct the full 100K against your ordinary income. That's W-2 wages, active business income, or anything that's taxed at your regular tax rate in the same tax year, not amortized over years, like certain real estate assets or business assets. It's not capped like a retirement contribution. You get to take the whole thing in year one. How we structure the oil and gas project, this is the highest deduction any investor can take amongst all the asset classes that you can invest in. And this even beats out my beloved real estate investments. Let me put real numbers on that. Let's say your combined federal and state tax bracket is say 40%, and you invest the 100K into this Anadarko project. When you file your taxes next year in April, you're gonna get additional $40,000 refund from the IRS. Like most of you, I used to not get any excitement filing my taxes. Now, it's one of the more fun things I do on my calendar. And this doesn't stop in year one, by the way. Every subsequent year, you also get something called a depletion allowance. Roughly 15% of your gross returns from the well, you can deduct that against your ordinary income. So the cash flow keeps coming in, and a meaningful chunk is shielded from taxes every single year for the life of the well. And here's the kicker. No one says you can't redeploy your earnings from year one into a new project the next year and harvest another 40K. Now here's where some of our investors get creative. If you wanted to, you could invest just enough into oil restoration or new drilling each year to reduce your tax rate down to what you're comfortable with, maybe to zero. That's not a loophole. That is how the tax code is written. The IRS writes these deductions specifically because they want capital flowing into domestic energy production. And if you participate in oil and gas production for the country, the IRS rewards you for it. And this is the piece that changes the math on investments. The cash flow alone makes this an interesting investment, yes. The cash flow plus tax deductions makes it the most efficient place to put capital in the US tax code. So let's wrap it all up together. Here's the money flow end to end. You own a percentage of production from a lease, and that percentage is called a working interest. After the mineral rights owners, the landowners, and other parties that allow us to be on the land, operate the lease, and continue the production, after they get their share, you get your net revenue interest, NRI. The remaining revenue gets split amongst the working interest owners, pro rata to your percentage. The IRS also allows you to deduct your entire investment in year one and gives you depletion allowances every year after for that particular investment. Cash flow paid monthly plus tax efficiency secured by a physical asset. This is how oil and gas investors on the inside make money. The outside investors in oil and gas usually will have to get exposure through publicly traded stocks. Now, if you are a credit investor and you want to see what we're working on next, or just stay current on how the oil and gas markets are shaping up for investors, we have a form on our website that allows you to join our deal flow, and we'll give you information updates along the way too. I'll put the form down below. We also send breakdowns of our active projects to our current investors, market updates, and all the macro stuff that every investor in oil and gas needs to know. And lastly, if you have specific questions about how you can leverage our projects for your portfolio, use our website to book with us, and I'll put a link down below as well. For that conversation, we need to connect personally and talk privately. This video is simply just to walk through a real example to educate newer oil and gas investors on how production translates into money in the bank every month for them. The funny thing is, most investors are only customers of oil and gas. They pay for it at the pump and never see a dollar of upside. The ones who become owners get paid every month for it. So at the end of the day, you're either an owner or a customer of oil and gas. It's just better to be both.